All right, let's wind down our discussion on the Vanguard Life Strategy Funds, taking 5% a year off, looking at the VASIX, which is the Vanguard Life Strategy Income Fund. I think that's roughly 20% stocks, 80% bonds. Again, it's diversified not just domestically, but internationally as well. So you got domestic stocks, domestic bonds, international stocks, international bonds. And inherently, if you're going to have life strategy aggressive growth, life strategy moderate growth, and life strategy income, you're going to have some differentials between the three, because one is heavy in stocks, one is moderately heavy in stocks, and one is conservative, and that doesn't have much stocks at all. So let's dive right into this. We're going to take 5%. Oh, that's what I meant to say. So don't forget to subscribe down below. Thumbs up, comments always help. And just watch the video for as long as you possibly can, because that helps me as well. So VASIX, the Life Strategy Income Fund. Again, all these Vanguard Life Strategy Funds were incepted in 1994. The reason we're only doing a 2001 is because that's when the Vanguard Inflation Protected Bond Fund was incepted, and the whole genesis of the series was using VIPSX, comparing it to VFIIX, Ginnie Mae, and using that with some of the other stock funds that Vanguard offers. But don't just think this is only Vanguard or only index funds. We're going to look at actively managed fund next, which is the Vanguard Wellesley, the Vanguard Wellington, and then we're going to dive into Franklin Income Fund, which is a wonderful fund, and then American Funds Income Fund of America, which is another wonderful fund. In fact, those are in my my repertoire of funds you might want to consider. All right, so now we got green for the first time after 2001. We have green. So all the other stuff we looked at before, other than VIPSX and other than Ginnie Mae, had red. So now we have green, even though we did have 20% in the market. So we still have $4,000 above what we started, which means we finally were able to get a full 5% a year. Or 5,000, in this case is 5203. I did take a little bit of a lump the following year, so our income dropped to $49.99. In 2005, again, we didn't take a lump, it's just we took out more than the markets gave us. So the market was up, but because we're taking 5% a year out, and the markets only gave us 3 or 4, whatever it was, we were down a little bit. But it's still well above the $5,000 threshold, which is we want to see. Until 2006, we're at 106,912, again 53.46. So we're sitting pretty. We put in $100,000. We got more than $100,000, and we're able to take well more than $5,000 a year, which is good. 2008 happens, and again, bond funds and stock funds alike got crushed, other than government bonds. That's right. And so if we have 80% of our holdings in bonds, international and domestic, and the bulk of those are in corporate bonds, we got hammered quite a bit here. So we're still down 16,000. The Vanguard Life Strategy Growth Fund was down 43,000, I think. It was in the 40s. The Vanguard Moderate Growth Fund was down 32,000. And then here we're down 16,000, and just goes to show you, if you want security, you're going to get it, but you're going to sacrifice upside. If you want upside, you're going to get it, but you're going to sacrifice security. It's just, there's no two ways around that, my friends. And we're able to take 45, 44 off the portfolio. In 2010, though, we were able to get back above 6 figures. So again, we started with 100,000, right back at 100,000. We started with taking 5% a year off, and we're right back right where we started. So after, 10 years and some serious market declines, we have right back to where we started, and we've taken $50,000 off the portfolio. So that's not too shabby. I mean, $100,000 in, $100,000 out. We've taken $50,000 of income. I don't think anyone would say that's bad. But now is when it starts getting a little bit dicey. You see a lot more red in here, and the reason for that is because the interest rates are just so low. 98,000, 98,000, 95, 94, 95. So now after 1, 2, 3, 4, 5, 6, 7, 8 more years, we are actually below where we started, and our income has dropped significantly from 5,000, well, not significantly, but it's definitely dropped from 5,000 to 4,700. So now we have a declining income base and a declining portfolio value, and it's only going to get worse because the interest rates are where they are. And so we're getting about, say, 2 to 3% a year in growth on the portfolio, but we're taking 5% a year off. So this will progressively get worse and worse. A lower and lower income, a lower and lower base for which to derive that income. It's just not looking good going forward for VASIX. So there you go. I mean, I'm here to tell you the truth, and the truth is what we see here, rightly or wrongly. You're going to have to deal with it. If you want just upside protection or you want upside growth, you're going to get it, but you'll sacrifice short-term volatility. If you want downside risk protection, you'll get it, but you're going to sacrifice long-term volatility or long-term longevity. No, what's the word I'm looking for? Stability. I don't know what the word is. But anyway, you're going to sacrifice long-term performance, because here we're down 5,000 below what we started with, and our income base is declining each and every year. It will never come back. It's all there is to it. Once the bonds start giving you less than what you're taking out, you're done for. It's just no other way around that. So subscribe down below. Keep watching. We got lots more videos on this to come forth. So see you next time.